Hi friends, welcome to my another class. Today macro chapter 2 unit 2. Earlier we learned unit 1 money. Now unit 2 is banking. Okay, banking means bank related activities. Bank is what? We people are related with the bank. All the people are related with the bank. Now generally those bank which we the common people are related, these are called commercial bank. Commercial banks. Okay, we people are related with the commercial banks. Commercial banks means whose main activities is business. How to make business? This is commercial bank. Okay, another bank is there. This is called central bank. In every country there is a central bank. In our India, this is Reserve Bank of India. In USA, it is Federal Bank of USA. This is central bank. Okay, now commercial bank is what? Their main activities is to make business in the country. How they make business? Suppose they actually work just like as a shopkeeper. Shopkeeper used to do what? They purchase commodities from the wholesale market at less price and used to sell their commodities at retail rate at high price. In between they make a profit. Commercial bank also do same thing. Suppose commercial bank used to borrow money and they used to sell money. How? Suppose if a person deposit 100 rupees to the bank in a commercial bank, how they will deposit money? Because people get interest against the deposit. Suppose bank provide 5% of interest. Means after 1 year, the bank will return back 105 rupees to that person. A is the person for deposit 100 rupees. Bank will return back him 105 rupees after 1 year. Now from where bank will get this 5 rupees? Okay, now when I deposit 100 rupees to the bank, bank will do what? Bank will give loan of that 100 rupees to different person. Suppose bank provided loan to B. How? At 11% rate of interest. Okay, now what B will do? B will return back to the bank 111 rupees after 1 year, and from that 111 rupees bank will return back me 105 rupees, and in between bank will earn a profit of rupees 6. This is the main activities of the bank. Bank borrow from us at less rate of interest and give loan at high rate of interest. In between bank earns a profit. This is commercial bank. So their main activities is to make business. So it is called commercial bank. For example, State Bank of India, Punjab National Bank, Grameen Bank, Axis Bank, these all are commercial bank. Their main activities is to borrow money from the people and give loan to the people. This is main activities. Now let us start with the function of the commercial bank. So let us start with the commercial banks. Commercial bank is those banks where whose more main activities is to make business in the country, and its main function is these three are the main function. One is primary function, one is agency function, another is general utility function. Primary function means basic function. Three basic functions are there. First one is accepting deposit. Second one is providing loans. Third one is credit creation. These are the three basic function or primary function of commercial bank. Accepting deposit means commercial bank's main target is to accept or collect deposit from each and every corner of the society. From the richest to the poorest person of the country, bank try to accept deposit from all the people so that people can deposit their money, and by using the money, bank can provide loan to the people. So second function is providing loan. Bank used to provide loan to the people of the country to fulfill their requirement of money. And third one is credit creation. Credit creation means in the process of accepting deposit and providing loans, bank are also able to credit create. How? We are coming later. So first one is accepting deposit. Accepting deposit means bank collect deposit from each and every person of the country. For that, to attract money or attract deposit from the people, bank main target is to collect deposit from each and every corner of the country. And for that, to attract deposit from the people, bank do what? Bank provides various types of deposit, so that each and every person, whether he is rich or poor, they can deposit money in the bank. First type of deposit is accepting deposit. To accept the deposit, bank used to provide various attractive deposit scheme to the people, so that people are attracted to deposit their money in the bank. Okay, generally 4 types of deposit are accepted in the bank. First one is current account of deposit. Current account of deposit means those deposit which are used by the business person, okay, where no interest is there. In current account, no interest. Why no interest? Because in this type of deposit, people can deposit anytime and they also can withdraw anytime. There is no restrictions in the number of deposit and number of withdrawals. So there is no interest is paid. So in current account, no interest is paid, but bank may charge some service charges in case of current account of deposit. Second one is savings deposit. What general people used to deposit, this is savings deposit, where we can deposit anytime any amount of money, but there is certain restrictions in withdrawals. That is check issues, how many check will be issued per month, this thing is restricted in the bank. So in savings deposit, there is no restriction in deposit, but there is some restriction in withdrawals. Here less interest is paid. Savings deposit. Recurring deposit is what? Recurring deposit is the sum of combination of savings and fixed deposit. Recurring deposit is this one, where we have to deposit a certain amount of money in every month, certain fixed amount of money in every month for a certain period of time, and after completion of the period we can withdraw the money. So there is huge restriction in withdrawals. Withdrawal is possible only after the maturity period. For example, suppose I deposit my fixed recurring deposit for 5 years. Condition is what? In every month I will deposit 2000 per month. Means every after month I have to deposit 2000 rupees continuously for 5 years, and after 5 years I will return back my money with interest. Okay, this is recurring deposit. In savings deposit, we can deposit any quantity of money anytime. If it is not possible, there is no problem. Whenever is possible, I will deposit the money. But here I have to continue for 5 years, per month 2000, and here rate of interest is more compared to that savings deposit. Little bit of more interest is provided against the savings deposit. Term or fixed deposit. Here only one time deposit for a fixed period of time. Suppose for 5 years I deposited 2 lakh rupees. Means what? After 5 years I will return back my money with interest. This is fixed deposit. This is one time of investment and one time of withdrawal. So there is restriction in deposit, restriction in withdrawal. One time I have to deposit the money and I will return back the money after completion of the maturity period. And that time rate of interest is so high. High rate of interest compared to fixed deposit and compared to recurring deposit. So these are the 4 types of deposit provided by the commercial bank to attract people, so that people can deposit money in their bank. So for deposit, current account where no interest is paid, savings account, deposit having no restriction but some restriction in withdrawals, interest rate is very low, recurring deposit where restriction in withdrawals, deposit we have to make after a certain period of time and every installment will be same for fixed period of time, and withdrawal is only possible after the maturity period. Interest rate is more than the savings deposit. Fixed deposit where money is deposited for a fixed period of time and after the maturity period we can withdraw the money, and rate of interest is high compared to the recurring and savings deposit. In current account no interest is paid but bank charge some service activities. Second primary function is providing loans. First one is accepting deposit. Bank accept deposit from each and every person of the society, and bank also provide money to the people so that people can fulfill their requirement of money. Okay, now 4 types of loans are there. provided by the commercial bank. One is cash credit. Cash credit means CC loan. This is generally provided to the business person. Okay, where people, those who are having current account, they are provided cash credit. Okay, how this is provided? Suppose a person is require certain amount of money and he used to take a cash credit of 10 lakh rupees from the bank. Bank will be issue 10 lakh rupees in his account, but whenever require money, he can withdraw the money from the bank. Suppose 10 lakh rupees is credited in his account, the person is require 5 lakh rupees. He will withdraw 5 lakh rupees from the bank, but interest will be charged only on that 5 lakh rupees. Rest 5 lakh rupees will be not be charged in interest. Okay, suppose again another he required 2 lakh rupees. Now total he deposited withdrawal 7 lakh rupees. Interest will be charged only on that 7 lakh rupees. Rest 3 lakh rupees will not be charged. Okay, this is cash credit, and such type of credit generally provided to the business person who are having current account. Okay, this is cash credit. Second one is demand credit. Demand credit is generally not found in the present banking system. Demand credit is what? Where loans are provided but bank may charge any time to return back the money. This is demand credit. Okay, that time interest rate is charged on the whole amount sanctioned for loan. Okay, suppose 10 lakh rupees is taken as loan, the interest will be charged on the whole amount of loan. Third one is short term deposit, which is generally used by the common people for purchasing house, purchasing car, like that, or any other requirement. Okay, that time interest is charged on the whole amount of loan. Suppose I had taken 5 lakh rupees, whether I withdraw the money from the bank or not, from the second day the interest will be charged on that 5 lakh rupees, and when I return back the money, that time there will be no interest. So this is short time loan. The interest is charged on the whole amount whatever is sanctioned by the bank. Fourth one is overdraft. Overdraft also be made on the cash credit. Okay, in current account, those who are the businessmen, they used to transact money every time. They deposit money, withdraw money. Now when the person withdraw more than the deposited amount, that time it is overdraft, that is negative savings. Third primary function is credit creation. Credit creation means how commercial bank create credit. Create credit means how they can expand their money. In the process of accepting deposit and providing loans, in between bank is also able to expand their money. This is called credit creation. In details we are coming in later. So these all are the primary function. Next, agency function. Agency function means as a agent. Agent means middleman or broker, we can say in short. So as a agent, bank perform various activities, and in between bank earns some commission, and this is agency function of commercial bank. Okay, first agency function is easy and cheap transfer of fund. Okay, by using commercial bank we can easily exchange our fund, or we can easily transfer our fund from one person to another, from one place to another, like that. This is easy and transfer of fund by using check and draft. This is easy transfer of fund, and in making of check and draft, bank used to charge some money. This is agency function. On behalf of us, bank easily or safely transfer our fund from one person to another through using check and draft. Second one is collection of funds. Just reverse thing of this one. Suppose a person used to provide money to me. So by using check or draft, he used to provide money, and if I use the check or draft and I will return back the money, and that time bank will charge some part of money from us. This is collection of fund. So on behalf of us, bank provide the facility of easy and cheap transfer of fund, and bank also collect fund on behalf of us. In between, bank charge some money. Number C is sale and purchase of shares. Okay, in share market, if if we sell share or if we want to purchase shares or bonds, we have to go through the commercial bank, and in between commercial bank charge some amount of interest, some amount of money. This is agency function of commercial bank. So if we want to sell our share or purchase our share, we go through the commercial bank. Fourth one is income tax consultancy. Okay, those who are paying income tax, bank provide them suggestion how they can reduce their income tax or how can escape from the income tax. This is income tax consultancy. Fifth one is executor and trustees of wills. Executor or trustee of wills means those who make wills before their death, that after their death their properties will be distributed among their ancestors. That time bank perform their duty. Bank distribute their property according to the wills, and in between bank charge a amount from the party. This is executor and trustees of wills. These all are the agency function of commercial bank. Means in between this exchange of transaction of money, bank charge some amount. This is agency function. Finally, we have general utility function. General utility function means common function which bank used to provide to the customers so that customer become interested in that particular bank. First general utility function is locker facility. Locker facility means people can deposit their valuable ornaments, valuable documents or papers in the bank, and bank used to provide them a locker, and for that bank charge a certain amount of money for that facilities, locker facilities. Traveler's check. Traveler checks nowadays it is not so useful. Earlier when there was no ATM or debit card or credit card, people used to take traveler's check so that people need not carry some huge amount of money with them. They used to take traveler's check, and wherever they require they used to use the check in the particular bank and they get money. This is traveler's check. Bank used to collect statistics regarding trade and commerce of the country so that they can help their investors in their business. Okay, so whatever is going on in the business activities, bank used to collect the statistics so that people, those who are taking loan from the bank, they should get the facilities from the bank, and bank give them suggestion where they have to invest, where they should not invest, like that. So these are the general utility function of the commercial bank, and this thing is provided only to attract their customers towards the bank. So this is our commercial bank and the three basic function of the commercial bank. Second part is central bank. Central bank's main activities is what? Central bank is there in a country. In every country there is a central bank whose main function is look after all the financial and monetary system of the country, and also control and the activities of the commercial bank and other financial matters of the country. This is central bank. In India, Reserve Bank of India is the central bank who look after all the banking and financial activities of the country. Generally, central bank is controlled and governed by the government of the country. Okay, now functions of the central bank. Now there are main four function of central bank. First one is issuing authority. Issuing authority means issue of currency notes. Okay, central bank having the power to issue currency notes in the country. Remember, only currency notes except all the coins and 1 rupee note. All the coins and 1 rupee note is issued by the Finance Ministry of India. So these are not published by the Reserve Bank. Reserve Bank published all the currency notes from rupees 2 to rupees 2000. All the currency notes are issued by the central bank. And this right has been given to the central bank. Why for? So that they are maintain uniformity in currency, and people should have trust on currency. Otherwise, people will have no trust. If all the commercial banks start producing currency notes, then currency notes will be different shape, different color, different design. That time people may lose their trust. So there should be trust on all the currency note, and currency notes supply also can be controlled. If it is supplied from one particular pocket, that is Reserve Bank of India, that time it can be easily control the supply. So issuing authority of the central bank. Second function is banker to the government. Banker to the government means as a banker to the government, it performs as an agent, as a banker and advisor of the central and state government. Okay, as an agent, what they do, all the banking activities of the government is performed by the central bank as an agent of the government. Okay, if government used to borrow from another country, this money is borrowed through Reserve Bank of India. If government want to give loan or some financial facilities to another country, that times also this is performed by the central bank, that is RBI, on behalf of our government. As a banker means all the banking activities of the central and state government is performed by the central bank. As an advisor means any kinds of financial crisis or any kinds of financial requirement, central bank used to advise to the central government how the government should follow the policies so that government can overcome the situation of crisis. So as a banker to the government, central bank perform three activities: agent of the government, banker of the government, advisor of the government. Third one is banker to the bank, very important function of the central bank. Banker to the bank means banker to all the commercial banks. Okay, means central bank is the father of all the commercial bank. All the commercial banks activities are controlled, regulated by the central bank, and commercial bank has to follow all the guidelines issued by the central bank. If commercial bank do not follow the guidelines, their registration may be cancelled. Okay, that time they may not make business in the country. So this is banker to the bank. First function is controller of credit. Central bank controls the credit creation capacity of the commercial banks, and for that various instruments are there. Okay, like bank rate, credit creation capacity, cash reserve ratio, statutory liquidity ratio, open market operation, marginal requirement, moral cession. This type of various types of policies are there so that commercial banks credit creation capacity can be easily controlled by the central bank. In details we are coming later. So this is first function, controller of credit. Second one is lender of last resort. Lender of last resort means when commercial bank fails in the business or they cannot recover all the money from the market and they cannot return back their money to the depositors, that time when commercial bank having no other options, they are not getting fund from anywhere, that time commercial bank take help from the central bank. Means central bank is the last assistance of the commercial bank, and that time central bank assists those commercial banks against approved securities or against approved guidelines or rules and regulation, so that commercial bank make business in the country and people have trust on the bank. Otherwise people will lose their trust. If commercial bank cannot return back the money, that time people will not deposit money in the bank, so that central bank assists those banks in times of crisis and when they are not able to recover fund from any other sources. Third one is clearing agent. Clearing agent means as a central organization, central bank make facilities so that commercial bank can easily transact their money from one bank to another. Nowadays we are very much familiar with the term core banking system. This thing is nothing but clearing house function. Core banking system means all the commercial bank are now connected, interconnected. Okay, how interconnected? We can deposit our money in any account, any bank, and we can also withdraw money from any bank in anywhere of the country. And this thing is possible by using clearing house function of the central bank. Central bank used to transfer their fund from one bank to another. Central bank used to collect fund from one bank to another. This is core banking system or clearing house function. By this we can easily, cheaply and within very short period of time we can make our money send our money from one place to another. We can collect money from one place to another. This is clearing house function. So these are the banker to the bank. And finally, custodian of foreign exchange reserve. Foreign exchange reserve means suppose if we want to collect foreign exchange, we have to collect foreign exchange from commercial bank. How from the commercial bank? Because central bank used to collect the foreign exchange by selling gold or some other ways, and it distribute the foreign exchange to the other commercial banks, and from those commercial banks we can collect the foreign exchange. So custodian of foreign exchange means central bank act as a custodian of foreign reserve, means whenever foreign exchange is required, central bank may sell gold and collect foreign exchange, or central bank can sell foreign exchange to collect gold from the other countries. This is custodian of foreign exchange reserve. So these are the four basic function of the central bank: issuing authority, banker to the government, banker to the bank, and custodian of foreign exchange reserve. Now important topic of this chapter is credit creation. By commercial banks. How commercial banks can credit create, or how commercial banks can expand their money. Okay, main activities of commercial bank is accepting deposit and providing loans to the people. Okay, this is the main activities of commercial bank, to collect deposit from the public and give loans to the public. Okay, in between, bank can create credit, that is bank can expand their money. Starting from a basic amount of money, bank can expand it in many times. This is credit creation or money multiplier policies. How it is done? Suppose a person deposited 1000 rupees to the bank. This is called primary deposit of the bank. Primary deposit, PD. This is the primary deposit, means bank started business with that 1000 rupees. Okay, now when bank receive 1000 rupees, it is not possible for the bank to return to give loan to all the monies. Bank has to deposit certain amount of money as legal reserve. Suppose 20% is the legal reserve ratio, LRR. Sorry, so 1000 is the primary deposit of the commercial bank. Now bank cannot give loan of full 1000 rupees, because bank have to keep certain amount of money to fulfill the cash requirement of the public. Suppose bank knows from its experience that 20% cash money is required to meet the requirement of the people. This 20% is called LRR, legal reserve ratio. Means bank has to maintain 20% of legal reserve ratio with themselves, so that if people used to take money from the bank, bank can fulfill their requirement. Okay, now 1000 is the starting amount. Bank used to do 20% as legal reserve ratio, means 20% of rupees 1000, that is rupees 200, bank will keep as legal reserve ratio, and rest 800 rupees bank will give loan to a person, loan to A. Suppose bank given loan to A. Now we assume that all the money of the country will be deposited in the banking system. This is an assumption. Okay, all the money is deposited in the bank in the country. So when A receive loan of 800 rupees, what A will do? A will keep the money in the bank, suppose, and from that 800 rupees again bank will collect 20% as LRR. That is 20% of rupees 800 means rupees 160 bank will keep as LRR, and rest 540 will be given as loan to B. Okay, means what? Every time bank used to deposit 20% as LRR, and rest of the money bank used to give loan to the public. Like that way, again 20% as LRR, and that is 20% of rupees 540. LRR, that is 160 as LRR, that is rest 640 will be given as loan to another person, suppose B, Again bank B will deposit their money in the bank. Like that way, every time bank used to keep 20% of LRR and rest of the money bank will give as loan. Like that way, continuously bank give loan. Starting with 1000 rupees first time, then bank created 800 rupees, then bank created 640 rupees. Like that way, if we continuously add these numbers, add these digits, 640 dot dot up to 0, it will be rupees 5000. This is the credit creation of bank. Means starting with the primary deposit of rupees 1000, bank is able to create 5000 rupees as credit creation. This is the credit creation policy of the commercial bank. Now how 5000? There is a formula. Credit creation is equal to primary deposit into 1 by legal reserve ratio. This is the formula how much money is created. Primary deposit was 1000 rupees here, into 1 by LRR is 20%. If we calculate it, it will be rupees 5000. Means what? Bank make a credit of 5 times. Starting with the 1000 rupees, bank created 5000 rupees. Means what? 5 times bank used to create 5 times of credit starting with the primary deposit of 1000 rupees. This is for 20%. If the percentage is different, then multiplier answer also will be different. So this is the policy of credit creation, how commercial bank create credit. Now question may arise, the person who used to take loan of 800 rupees, bank do what? Bank keep only 160 rupees and rest of the money bank given loan to the another person. Now if A want to withdraw all the money, from where bank will return back the money, okay, because bank given already 640 to another person. If A require the whole money, the bank will do what? Bank will give money from another account, because it is not necessary that only one person is deposited in the bank. Lot of people are deposited crores of money in the bank. Means what? Lot of accounts are there. If any person want to withdraw all the money, bank can easily give money from another account, because in the bank you have to remember number of deposit is always more than number of withdrawals. Maximum people deposit money, very few people withdraw money. Bank having the experience of that. Based on that experience, bank used to keep only 20% as LRR suppose, and rest of the money bank used to give loan. So if anybody want to withdraw all the money, bank can easily give him money from another account. Okay, this is the policy of credit creation, and by this bank can easily expand their money starting with a minimum amount, suppose 1000 rupees, and some transaction bank is able to 5000 rupees, that is 5 times. This is the policy of credit creation. From there generally 4 marks of question is asked, where we have to give one numerical example like that. Another important topic is controller of credit. Of commercial bank by central bank. Okay, earlier we learned how commercial bank create credit. Bank is able to create credit, that is bank can easily expand their money. Okay, now this thing is controlled by the commercial bank, and commercial bank controlled by the central bank. Central bank can easily control the credit creation capacity of commercial bank, and also central bank is able to control the supply of money. Credit creation of commercial bank and supply of money, both can be done by the central bank. How? By using various instruments. First one is bank rate policy. This topic is very much important for chapter 3 also. In details you will get based on that topic. Bank rate policy is the first policy of the central bank to control credit and money supply in the country. Bank rate policy means the lending rate of commercial bank. This is also controlled by the central bank. What will be the lending rate of commercial bank? This thing also decided by the central bank. Now, when there is more money supply in the country, or suppose central bank want to reduce the money supply from the country, then what the bank will do? The central bank will increase the bank rate. If bank rate is increased by the central bank, then what happen? Commercial banks rate of interest also will increase. That time people will be less interested to take loan from the bank, because if they take loan they have to pay more interest. So what happen? Automatically money supply will reduced in the country. This is the first policy, how central bank can control the money supply or credit creation capacity of commercial bank. Reverse thing, if central bank want to increase the money supply, they will reduce the bank rate, that is rate of interest. Then people will take more loan, means more money will be circulated in the country. This is bank rate policy. Second one is cash reserve ratio. CRR. And third one is statutory liquidity ratio. SLR. These two things almost same, CRR and SLR. In CRR what happen? Every commercial bank has to maintain certain amount of money with the central bank. This is CRR, cash reserve ratio. SLR is what? In SLR, every commercial bank has to maintain certain amount of cash reserve with themselves according to the direction of central bank. Here they deposit money with the RBI, and here they deposit money with themselves. Okay, these two things is CRR and SLR. By these two instruments, the central bank can control the money supply. How? If central bank increase the CRR, then commercial bank has to maintain more deposit with the central bank. Suppose commercial bank having 100 rupees in their hand. Okay, now central bank do what? Generally CRR is suppose 10%, means commercial bank has to keep only rupees 10 as CRR to the central bank. Now if the central bank want to reduce the money supply, they make it 30%. Means what? Out of 100 rupees, 30 rupees they can save as CRR to the central bank, and rest 70 rupees they can give loan in the country. Means what? Their loan giving capacity reduced. SLR also same thing. Generally suppose SLR is 5%, means whatever deposit bank have, they have to keep 5% deposit with themselves. Without permission of RBI, they cannot use the 5% money. Means out of 100 rupees, they have to keep rupees 5 as SLR, and rest 95 they can give loan. But if SLR is increased from 5% to 35%, suppose, now what happened? Earlier they used to deposit 5 rupees with themselves. Now out of 100 they used to keep 35 rupees as SLR, and rest 65 rupees only they can give loan to the country. Means what? Their loan giving capacity reduces. So by using CRR and SLR also, central bank can control the credit creation capacity of the commercial bank. Their loan giving capacity is reduced and money supply also reduced. Reverse thing happen if central bank want to increase the money supply. Fourth one is open market operation. Open market operation, OMO. Open market operation is a procedure of sale and purchase of bonds and securities on behalf of central bank through commercial banks. Okay, the process of sale and purchase of government bonds and assets and securities through commercial bank by central bank is called open market operation. Okay, now how it can control the money supply? Okay, if there is more money supply in the country, then what the central bank do? Central bank starts selling the securities, through commercial banks in the market. So what happened? All the money is carved by the central bank from the market by selling the securities. Okay, when central bank starts selling the securities, commercial bank purchase the securities against their cash reserve. So what happened? Their cash is now blocked with the Reserve Bank of India, and their loan giving capacity automatically reduced. Okay, on the other hand, when central bank want to increase the money supply, or if want to increase the credit creation of commercial bank, that time central bank start purchasing the securities from the commercial bank. So what happened? Commercial bank will return back their securities to the commercial bank, and they get their cash in their hand, and automatically they can give more loan to the public. This is open market operation. When central bank want to control the money supply, they start selling the securities, and commercial bank's cash reserve is blocked with the central bank. They cannot give more loan. And when the central bank want to increase the money supply, they start purchasing the securities from the commercial bank, and commercial bank return back their cash money in their hand, and they can easily give more loan to the public. So by this way also they can control the money supply in the country and credit creation of commercial banks. Fourth one is marginal requirement. Sorry, fifth one, margin money. Marginal requirement means when we want to take loan from the bank, we have to keep something as a mortgage. Marginal requirement. Okay, mortgage means against some securities we can take loan from the bank. Now if marginal requirement is 20%, means whatever I deposit in the bank against loan, I will get 20% less value of that loan. Okay, suppose I deposited gold in the bank of rupees 1 lakh. Okay, 1 lakh rupees of gold I deposit in the bank, or suppose I deposited some asset in the bank as a mortgage whose market value is 1 lakh. Now if marginal requirement is 20%, means I will get loan of 80,000 rupees from the bank. Okay, this is marginal requirement. 20% less money I will get as loan. Now when central bank want to reduce the credit creation capacity, that time central bank do what? Instead of 20%, they make it 40%. Means what? Against gold of 1 lakh rupees, I will get only loan of 60,000. Means what? My credit creation, my credit loan taking tendency will reduce. Automatically money supply will reduce in the country. When there people get less amount of credit against certain amount of deposit, people interest reduces. That time they will take less loan. If central bank want to increase the money supply, suppose instead of 20%, bank make it 5% marginal requirement. Means out of gold of 1 lakh rupees, now we are able to take loan of 95,000. That time people will be more interested to take loan. That time money supply or credit creation of commercial bank also will increase. This is marginal requirement. Sixth one is moral cession. Moral cession means all the guidelines, all the rules, regulation, restrictions which the central bank impose on the commercial banks. This is moral cession. Okay, during excess demand or during when there is more money supply in the country, central bank may give some guidelines to the commercial banks so that they should not give more loans to the public. They should reduce their money supply or reduce their credit creation capacity. These types of moral cessions are there. Means all the guidelines, rules, regulation, restrictions which the central bank used to impose on the commercial bank. This is moral cession. So based on these 6 instruments, central bank can easily control the money supply or credit creation capacity of commercial banks. Okay, now from this topic you must get one question, and the same topic is also there in chapter 3. Okay, in chapter 3 macro, where details one unit is there based on this 6 topic. So this is very important for this chapter also and next chapter also. Okay, so that's all of this chapter, money and banking.